Hi everyone, in this tutorial I will talk about the capital budgeting. I was preparing for CFA level 1 exam and I thought that I should share some of the concept I learned during the preparation. So we are talking about capital budgeting, so for a company there is always a need of capital so that company can undertake the new projects, and they can generate money or capital from three different sources. One of the source is from the bank. So when they take the money from the bank, we call it debt. And the good thing about debt is that when you file the income tax, then there is no income tax on the debt, or you can file for deduction on the income taxes in the amount of the interest you have paid. So if we talk about how much does it cost, so suppose if bank is charging us 10% interest rate and the corporate tax is uh, the 40%, then we will be actually uh, saving 40% on the interest we have paid. So therefore the total amount of uh, cost for that will be 10% minus 1 minus 0.4, or only the 60% of it. So we can say that the the cost of the debt was only 6%, because 40% is saved on the interest we paid in the tax, in the form of taxes. Now the other source of capital, so this was first source of capital. The other source of capital is the preferred stock. Preferred stocks, yes. So what is preferred stock? So suppose if a company needs a large amount of money, and they wanted to so they can go to a wealthy person and then tell that person or a company that if you buy our stock, we will give you a 5% or a 10% or a particular amount of percentage of dividend every year. And the company may not be paying this dividend to everyone, but especially to that person or the company, because they wanted to generate a large amount of cash and they don't have any other option. So in that case, how does we calculate the cost of the preferred stocks? So suppose if the company stock is $50 and they are paying, so this is the price of the stock, and then they are paying $5 as a dividend. So in that case, we will say it's a 10%. So the cost of the capital through preferred stock was 10%. And the third way to generate money is through equity. So we call it equity. So what is equity? Equity is the investment by the owner. So suppose if you are the owner of the company and you want to start a project, you are not able to raise money from somewhere else, or you have money to invest in the company, so you can put your own capital, and that will be considered as a equity. Or you can find another partner who is able to invest in your company, and then you will also call that a equity. Or otherwise you can issue some new stocks in the market. Then if you issue new stocks, they will also be kind of a partner or the owner of the company, partial owner of the company, and that money which is coming from the common stocks is also called as equity. So how does we calculate the cost of the equity? So the way to calculate the cost of the equity is the expected return. So suppose if you are the owner and you want to invest in the company, you say that, oh, at least I want a 5% return on my investment, otherwise I won't be investing. So based on your expectation, you call that the the rate of the equity. Suppose you want to calculate what is the total cost of capital we have. So the total cost of capital will be equal to so what we did is before is we had 10% from debt, and we multiply it by 1 minus uh, 0.4, Then we have 10% from preferred stocks, and then we have 5% from equity, right? And now suppose we are generating 10 millions from debt, and um, 20 millions from preferred stock, and 10 million from equity. So in this case, what we'll do is we multiply them by 10, multiply this by 20, multiply this by 10, and then divide everything by the sum, which is 40. So that will be equal to 6 into 10 plus 10 into 20 plus 5 into 10 divided by 40. So that will be my cost of capital. So now let's go to the company's decision making for whether to take the project or not. So now we know that how much is the cost of the capital to the company. And now suppose the company look at the projects. So they could be different projects that company can take. For example, project 1. So project 1 says that let's invest $1 million today, so which has a negative cash flow of 1 million, and then you will get for next 10 years a cash flow of 0.2 million. So after 1 year you will get 2 million, after 2 years you will get 2 millions, and after same way after 10 years you will get 0.2 million. So what can company do? So company can look at this project in two different ways. One is that it can use its cost of capital. So suppose cost of capital is R, or the answer from the top from this is R. Then what we can do is we can calculate the present value of all this future cash flow. So we can do is we say minus 1 million and then plus 0.2 million divided by 1 plus R, and then plus 0.2 million 1 plus R square, and plus so on, and then 0.2 million divided by 1 plus R raised to power 10. And we can calculate what is the net present value. So this will give us the net present value of the project. The other way to, so if your net present value is positive, then you should go for the project because you are making a money. And if the net present value is less than 0, then you should not take the project because it's not good for the company, because you will lose the money in that case. The other way to look at the project is the internal rate of return. So in this case, instead of using R from the cost of capital, we equate net present value equal to 0 and then calculate R. So we calculate what is the rate of the return. So suppose, so let's go back here, and we can calculate this. So this was 60 plus 200, 260, 310. So it is 310 divided by 40, which is approximately equal to 4 7 the 28, and 4 7 the 28 and 70s. So it's approximately to 7.7 percent, right? And then we can come back here and calculate the R here. So if R is greater than 7.7%, it's greater than 7, so the project is good. And if R is less than 7.7%, then the project is bad, we should not take the project. So this is another way to calculate the uh, the or evaluate the project. So sometimes if the company is comparing the two projects, it can have contradictory results for net present value and internal rate of return. Sometimes the net present value, suppose if you have a project which is like, suppose now we calculate net present value, right? So suppose if, suppose you have a project one. So project one will give you a cash flow of 100 millions. So you invest 100 millions and then you get uh, 20 million each for next years, right? So you invest 100 and then you get 20 each for next years. And there's another project, project 2, which gives you which requires a cash flow of 1 million and then give you a return of uh, 0.2 million, right? So in this case the net present value will be higher for, so net present value is for project 1 is greater than net present value, net present value for project 2. So but IRR should be same. So should we take a decision based on IRR or net? So in this case, we will take the decision based on the net present value. However, if instead of point 2, if the return in this project would have been 0.19 and 0.19, so in this case the IR, or not 0.11, like take it 2.1, so like 2.1 and 2.1. So in that case the IRR would have been like this. So IRR for project 2 would have been greater than project 1. So in this case we have a contradictory result because the net present value of project 1 is greater than project 2, but the IRR is less than, for project 1 is less than project 2. So what should company do? The company should take a decision towards the like for the better net present value. So net present value is preferred when it comes to the choice of the project between two of them, but they are giving the contradictory results based on IRR and net present value. Now let's look at the opportunity curve. So now suppose this is the curve and this is the capital. So now if the company wants to generate the capital, so this is your cost of capital. So as you know that if the company wants to generate just like small amount of money, then it can just go to the bank and bank will give them the loan, and that will not cost much to the company, or they can issue some stocks. But as they try to get more and more debt, then the bank will be more cautious, and then because of that they will increase the interest rate, or they might have to go to some secondary sources which can have a higher cost or the higher interest rates. So first of all, like suppose, like I can give you an example, like suppose if you have, if you want to get a debt and you have bank 1 and bank 2 and bank 3, right? So if you want to take loan from bank 1, it give you 4% interest, and bank 2 give 5%, and bank give 6. And it can give you 1 million, this can give you 2 million, this can give you 1 million. So when you want to generate your first 1 million, you will go to bank 1 and you get your cost will be 4%. But now if you, so now if you want to generate one additional million, then you won't go to bank 3 but you go to bank 2, because bank 1 is not giving you any more uh, loan, right? So let's write it million So your cost of capital will increase. So for first million, 1 million, cost of capital is 4%. When you get 2 million, the cost of capital will be now 4.5%, because you're paying 4% to this and 5% to bank too. So this is how your project or the cost of capital will increase. So you can see that as you go on increasing the capital, your cost of capital will, so your curve will look something like this. So your cost of capital will increase. And same way, if you look at the project, so suppose you have project 1, project 2, project 3, and the project 1 will give you 20%, uh, project 2 will give you 15%, and project 3 will give you 10%. So for sure you will first, if your first preference will be project 1, so you will apply your add your money to project 1. So you will start, so your first investment will be here. And then as you try to invest more and more, your choices for good projects will go down, and you will left with the projects which provide you lower returns. So slowly your schedule for investment, so this is your schedule for investment, and this is your cost of capital. So your schedule for investment will go down and your cost of capital will go up. So at what point you should stop investing? So you should stop investing at this point where your cost of capital starts to be more than your return on the projects. So you should at the company should be always be try to reach this point where they can generate the additional capital for the projects uh, which will be providing more return than the cost of the capital. And uh, and the money which is required to, or the total money which is um, used at this point is called the capital target, or the capital which a company generates for it to go for the. So same way, so you can see that if the um, interest rates are decreased, or the money supply has been increased in a country, then obviously your cost of capital curve will go down, and you will be able to take more projects, and that will somehow simulate the economy. So this is was few of the things which I learned in the CFA, and we can talk about more in the next videos. So thank you.